you're not alone. The rise of algorithmic trading platforms has opened the door for everyday traders to automate smart, effective strategies in markets like indices, equities, and crypto. In today's video, I'm going to show you how to build algorithmic trading strategies that are not overly complex, but still incredibly powerful. We'll cover real-world strategies that work, explore why simple systems often outperform complicated ones, and I'll show you how to approach strategy development using tools like StrategyQuantX, even if you've never written a single line of code. This video is for beginner retail traders and intermediate quants alike. If you're tired of emotional trading, inconsistent decision-making, or just want a smarter way to trade, stick around, because I'll also share insights from actual research, industry-tested practices, and some pitfalls you definitely want to avoid. Let's dive into the world of algorithmic trading strategies that actually work, and more importantly, that you can start using today. Algorithmic trading has grown explosively, even among retail traders. Industry blogs note a surge of about 50% growth in retail algo trading over the past 3 years. This democratization is driven by tools that remove technical barriers. Platforms like StrategyQuantX let even non-programmers build professional-grade trading strategies with a few clicks. Using visual editors and templates, a trader can drag and drop logic blocks, RSI, moving averages, ADX, stops, etc., to define entry and exit rules. The result is an algorithmic system built from familiar concepts, but powered by automation. This approach is crucial because automated systems offer clear advantages in today's markets. Consider cryptocurrency trading. Markets never sleep, operate 24/7 globally, and are fast and volatile. Analysts estimate well over 60 to 70% of trading volume on major crypto exchanges is now executed by bots. A human trader simply can't monitor hundreds of coins around the clock or react in milliseconds to breaking news. Algorithms can. They execute orders in fractions of a second at precise price levels and stay emotion-free, even through panic or FOMO. They can also multitask. A single computer can simultaneously follow dozens of crypto pairs, equity tickers, or index futures. In short, automation lets you trade faster, smarter, and at scale, turning your trading plan into precise, consistent execution. What kinds of strategies can a beginner or intermediate quant use? The key is to start simple. Classic trend-following setups and mean reversion patterns are a great entry point. For example, one of the simplest momentum algorithms is the moving average crossover. Buy when the short-term MA crosses above the long-term MA, and sell on the reverse. As one tutorial puts it, moving averages are the perfect beginner trading strategy. They clearly visualize the trend and give straightforward signals. Likewise, momentum-based rules, such as entering a trade when an asset's price climbs above its 10-day moving average or RSI crosses a threshold, are easy to code and often work well in trending markets. Some beginner guides even suggest starting with a short look back, like a 10-day momentum rule, which often captures medium-term swings without overtrading. On the mean reversion side, strategies using RSI or Bollinger Bands target oversold or overbought conditions. For instance, a Bollinger Bands mean reversion algorithm might go long when price dips below the lower band and go short above the upper band, betting that price will revert to the mean. These ideas are easy to grasp and test. Trend following and mean reversion systems can be applied across markets. On stock indices and ETFs, a classic momentum strategy is simply to buy stocks that make new all-time highs. Quant research finds this very basic, breakout, system can be surprisingly powerful. One study showed an equally weighted portfolio of U.S. stocks breaking all-time highs, with a trailing ATR stop, returned nearly 19% annually, sharp approximately 1.2 over 2 decades. In fact, quant analysts conclude, trend following on stocks does offer a positive mathematical expectancy. A related idea for indices is to exploit short-term calendar patterns. For example, a turnaround Tuesday strategy has traders look for reversals after a Monday move. If Monday's trend fades, they use Tuesday to jump in the opposite direction. Such simple time-based rules can work on major indices, S&P 500, NASDAQ, etc., because market participants often follow weekly routines. In cryptocurrencies, both momentum and reversion ideas are popular but come with extra volatility. For instance, one recent Bitcoin study tested both trend following and mean reversion rules over 2015 to 2024. The trend strategy, buying short-term highs, remained effective, while the mean reversion leg, buying dips, struggled in the recent bear cycle. In practice, many crypto algos combine both. Buy extreme dips on one coin while riding a rally in another. Other crypto-specific patterns include breakout entries after low volatility periods or arbitraging price differences across exchanges, though such arbitrage needs low latency. For equity markets, a beginner might try a simple RSI mean reversion on broad ETFs or a breakout filter on sector ETFs. The important point is, choose familiar indicators and apply them consistently across symbols, e.g., buy oil ETF when RSI 1470. Once you pick a strategy framework, a practical next step is to use a systematic tool to refine it. This is where StrategyQuantX, SQX, comes in. It lets you take those basic ideas and automate the grunt work of strategy generation and testing. You can start by loading historical data for your market of interest, stocks, futures, for indices, or crypto. SQX provides pre-built templates, like mean reversion, or trend following, and visual workflow steps. For example, you might drag in logic blocks. Entry: RSI, 14, less than 30 and price crossing below lower Bollinger Band, and exit: fixed take profit and stop loss. You can mix in trade filters too, e.g. only trade when volatility is above some threshold, or skip trades on low volume days. All this is defined through drop-down menus and diagrams, no coding needed. After you assemble your entry-exit criteria, SQX will automatically generate numerous strategy variants by exploring parameter combinations via genetic algorithms and other optimizers. In other words, it tries millions of permutations of your rules to find those that historically would have profited. However, we must stress, a good-looking backtest is not enough. The real test of an algo strategy is how it holds up under changing conditions and realistic assumptions. This is another area where StrategyQuantX adds value. It includes a robustness testing suite, for example, Monte Carlo simulations and walk-forward analysis. Monte Carlo testing shuffles the trade list, injects random slippage and volatility shocks, and shows how equity curves can vary, revealing hidden risks. Walk-forward analysis repeatedly optimizes on one slice of data and tests on the next slice, to mimic real-live evolution. Trading educator Ali Casey emphasizes that no tool can replace understanding robustness. A strategy that looks good must survive these stress tests or it's likely just curve fitting. As one LuxAlgo guide puts it, overfitting occurs when a system is overly tailored to historical data, yielding flashy backtests but failing in live markets. To avoid this, SQX encourages keeping models simple, few parameters, and validating with fresh data, exactly what advanced testers like Walk-Forward and Monte Carlo are for. Despite its power, beginners should watch for common pitfalls. A consistent refrain in trading forums and blogs is that 99% of algorithms have bias, most backtests are unknowingly over-optimized. Common sources of error include look-ahead bias, using future data in the past, survivorship bias, ignoring delisted stocks, and raw curve fitting by trying too many parameters. As QuantStart warns, any backtest should be seen as an optimistic upper bound on performance. In practice, it's vital to subtract realistic transaction costs, assume occasional slippage, and limit the number of trades so as not to exaggerate returns. Risk management is equally crucial. Many experts advise risking only 1 to 2% of capital per trade and never using extreme leverage. In other words, a strategy that modestly outperforms the market with tight stops can be much more valuable than a casino system that blows up from one bad week. As one blog reminds us, no single strategy guarantees profits, and proper risk management is crucial. Always conduct backtesting, robust testing and consider paper trading before going live. There are also debates in the algo community to be aware of. One hot topic is the role of complexity. Is a fancy machine learning model better than a rule-based system? The consensus tends to be caution. Machine learning can offer incremental insights, but it often overfits without clear interpretability. Indeed, some studies show ML models that shine in backtest, crumble in live trading. Similarly, HFT-style tactics, sub-minute trades, may be out of reach for most retail brokers, so it's wiser to focus on daily or intraday, minutes, timeframes that suit your execution. Others discuss whether markets have already arbed away simple edges. The advice here is to keep evolving strategies. For instance, once you see one moving average crossover fail, consider adding a filter, like only trade when volatility is above average. Building a portfolio of uncorrelated strategies, e.g. combining a crypto momentum algo with a mean reversion equity strategy, is a common best practice to smooth overall returns. In summary, the most effective beginner-friendly algo strategies are those grounded in clear, time-tested ideas. Trend following, momentum, and mean reversion using simple indicators, moving averages, RSI, MACD, Bollinger Bands, etc. The market examples span indices, e.g. S&P futures trend trades or calendar patterns like Turnaround Tuesday, equities, e.g. all-time high breakout, systems, and crypto, e.g. short-term momentum in Bitcoin. The practical workflow is: pick a simple idea, implement it in a tool like StrategyQuantX, rigorously backtest with realistic assumptions, and stress test with Walk Forward or Monte Carlo. Always include stop-loss rules and prudent position sizing. Perhaps most importantly, remain skeptical of any system until it proves itself out of sample. As one leader puts it, think less about guaranteed profits, and more about the lessons each strategy teaches you. With this mindset, even beginner traders can harness algorithmic techniques safely, using modern platforms and best practices to trade indices, crypto, and equities in a robust, disciplined way. So now you've seen that algorithmic trading doesn't have to be complicated to be effective. Whether you're trading the S&P 500, crypto like Bitcoin, or individual stocks, the real edge often comes from clarity, consistency, and proper testing, not complexity. Tools like StrategyQuantX make it possible to take a simple idea, like a moving average crossover or RSI reversion, and turn it into a fully automated system, backed by historical data and stress tested for robustness. But remember, backtest results aren't the final answer. Real-world markets are dynamic, so strategies need to be resilient, not just optimized. If this video helped clarify your path into algorithmic trading, give it a like, share it with someone else exploring the same journey, and subscribe for more content like this. And let me know in the comments, what's your favorite simple strategy? Or what's the biggest challenge you face in building one? Thanks for watching, and as always, trade smart, test thoroughly, and keep learning.